In this video, we cover Chapter 3 in my book, Audit Risk Assessment Made Easy. And this chapter has to do with materiality. I find that many CPAs struggle with the concept of materiality because it's subjective. I'm going to give you some particulars about how to compute materiality so you'll be more comfortable with this concept. But before I give you the details on computing materiality, let's discuss what it is. So many times when auditors are looking at a set of financial statements, they're wondering about the number. But I want you to think for a moment about the concept of materiality before we go to the specifics. So what is materiality? Let's bring up the definition, and I don't want to bore you, but let me read this definition just for a moment and then we'll talk about it. So it says the omission or misstatement of an item in a financial report is material if, in light of surrounding circumstances, the magnitude of the item is such that it is probable that the judgment of a reasonable person relying upon the report would have been changed or influenced by the inclusion or correction of the item. Now, you may be wondering, like me, well, who is the reasonable person? These are the people that are reading the financial statements. And there's a little bit of an assumption here that these people would have the education and background to understand financial statements, at least at a certain level, and that they have the ability to rely upon the report. So the question here about materiality is, let's say you left out a certain disclosure in the financial statements, and that disclosure was material. Well, that would mean that disclosure, notice at the end of the definition here, if it had been included or corrected, in this case, if it had been included, it would influence the decision making of the user of the financial statements. So that's how we know if something is material. If, say a line item such as receivables is incorrect, an incorrect amount would influence the user's ability to make decisions, then it's a material misstatement. So if you're looking at line items in, say, in the balance sheet or income statement or cash flow statement, you're thinking about how correct those lines are, such as cash, receivables, debt, payables, revenues, expenses. So you're thinking about how much error can be in one of those lines and it not impact the decision-making ability of the financial statement user. So who are the users of the financial statements? Well, normally they're bankers, lenders, management, owners, sometimes regulators. So those are examples of users of the financial statement. So as we opine on the numbers, as we render an opinion on the balance sheet and income statement, on the disclosures, on the financial statements, we're doing so to give comfort to these users of the financial statement, such as a lender or a banker or, say, an owner. So we're thinking about these people in terms of what materiality is. If an owner's looking at the financial statements and say a disclosure's not there that should be there and it would influence her ability to make good decisions, then That's a material misstatement. If a line such as, say, debt is incorrect by a certain amount, and it would influence a banker's decisions about whether to make a loan, then that's a material misstatement. So as you think about materiality, always consider who the users of the financial statements will be. In that context, we audit and we determine what materiality is. So now let's get to the details of how to compute materiality. What are the mechanics? What's the step-by-step in computing materiality and documenting that in your work papers? So the question is, how should you compute materiality, or how do you go about doing this? And the first step you're going to do is select your benchmark. So your benchmark could be total assets, it could be total revenues, total expenses, net income. For some clients, it might even be the total plant, property, and equipment. Say for an electric membership corporation that has a lot of PP&E, then the benchmark for them could be plant, property, and equipment. The ones that I see used most often are total assets and total revenues. Now, you could also use net income or income before taxes for some clients, such as, say, a bank. Typically, net income or income before taxes is not a good benchmark for, say, a real small business. But for a bank where you hope the income before taxes is fairly constant, then that could be an appropriate benchmark. But for most businesses, auditors will use either total assets or total revenues as their benchmark. Now, once we determine what the benchmark is, we're going to see in a moment that we will apply a percent to that benchmark, and I'll explain how to select that percent. But let's talk just for a moment about selecting the benchmark. So which of these is appropriate for the audit that you're performing? Well, we go back to the definition of materiality, and you'll recall we were just saying that as we think about materiality, we're thinking about who the financial statement readers will be. So for you, if the financial statement reader is, say, a lender and the owner, if those are the primary users, then which of these metrics is most important to the owner and, say, to the lender? So you're thinking about those potential financial statement users, the people that will read the financial statement, and then you're asking yourself, out of the potential benchmarks, which one is the most important to the readers? And let's say we select total revenues. And let's say total revenues is $10 million for the business that you're auditing. Well, that's your benchmark that you're going to apply the percent to. But let me emphasize again, the selection of the benchmark is dependent upon who the expected users of the financial statements will be. Now, let's apply the percent to the benchmark. So we said $10 million might be a benchmark for a business that you're auditing. Now we're going to apply a percent to that number. And the percentages vary. And, all of materiality involves subjectivity. It involves your judgment, something that some auditors really don't like. we like debits and credits, things that are certain. But here you've got to make a subjective judgment about the benchmark, and then you've got to make a judgment about the percent to apply. Oftentimes I'm seeing a 1 to 2% factor being used in relation to total assets or total revenues. If you were using income before taxes or net income, then that percent would be much higher because the net income number will be much smaller, say, than total assets or total revenues in most cases. So I said there was a range. It goes from like a 0.5% up to 2% for total revenues, total assets. How do you know which percent to use? Well, there's an inverse relation in the amount of risk that you have and the percent that you will pick. So the higher the risk for the entity, the lower the percent you'll use. So if you have a real high-risk client and you feel like there's a potential for material misstatements throughout the financials and you're not feeling comfortable about this, or maybe there's a certain area where it's really risky, you're going to bring your percent down. So you might use a 0.5%. Conversely, if you have a client that does a really good job and say you've been doing the audit for 10 years and you hardly ever have a proposed audit adjustment, well, now we're going to bring that percent up, and we might use, say, 2% of revenues rather than, say, a 0.5%. So you see how the percentage selection is related to the risk. Of course, the lower your factor, the lower the percent used, the lower your materiality number is, which means you've got to do more work. And so don't bring materiality down lower than it should be, because you're going to have to do more work. Now, if the entity has a high risk of material misstatement, by all means bring it down. You must bring it down. But if the risk is not there, then using that higher percent will save you time in performing the audit. And this materiality number, it affects everything you're doing. In other words, it will affect how you audit cash, receivables, debt, payables, revenues. So it has a very pervasive impact. So make sure you don't go too low with the materiality percent, because if you do, it can really create more work throughout your audit. So again, the two things you're doing: first, you're picking that benchmark, and second, you're applying a percent. So we said in selecting the benchmark and the percent, on the benchmark, we're thinking about who? Yes, the users of the financial statement. So that's how we pick the benchmark. Which one of those areas is most important to the users? Is it total revenues, total assets, income before taxes? What's the most important number? And whatever it is, that's the benchmark we're going to use. And then we select the percent based on how we feel about the risk within the financial statements. And let me be clear, the risk we're talking about is the risk of material misstatement. So the more you think there's a risk that misstatements are present, the lower that percent is going to be. Now let's talk about another part of materiality, and this is one area that I find that auditors get confused about, and it's the area of performance materiality. So let's say we computed materiality, say based on total revenues, and we come up with $1 million as materiality. When we're looking at performance materiality, we're normally using a percent of total materiality. So in this example, total materiality is $1 million, and our performance materiality, we'll say it's 75% of total materiality. So that would give us $750,000 as our performance materiality. You know, your $1 million applies to all the areas in the audit. The performance materiality, we're drilling down to specific transaction classes or account balances. So when we look at the $750,000 of performance materiality, we're relating that to cash, receivables, plant, property, and equipment, accounts payable, debt, revenues, expenses. So you're bringing down materiality to a lower number. Now, you may be wondering, why are we doing this? Well, we need a cushion in the performance of the audit. And why do we need a cushion? Because there's always a potential for undetected misstatements. So as you're doing the audit, you're proposing audit adjustments to make corrections in the financial statements. And you might have, say, 6, 7, 8 entries that you propose to the client to correct their books. And you might be thinking, okay, well, I found every material misstatement, when in fact there's 1 or 2 undetected misstatements out there. You're just not aware of it, or I'm not aware of it. So we're bringing materiality down, or we are lowering materiality because there's a potential for undetected misstatements. In other words, we're creating a cushion to protect us from the threat of an undetected misstatement. So as you plan your audits, you're going to use a performance materiality factor, and most auditors will use 50 to 75% of materiality. Again, the higher the risk, the lower the percent, just like when we talked about applying the percent to the benchmark earlier. In this situation, let's say you're looking at the company and it has a lot of risk and material misstatements. Well, then you're going to bring your performance materiality down below 75%. You might bring it all the way down to 50% for an entity that has high levels of the risk of material misstatement. And we're doing this for each transaction cycle and each account balance. So you're creating the materiality number and the performance materiality number as you plan the audit. So this is something you should be doing early on in the engagement. And you know, why is all of this important? Well, in order to do everything we're talking about in this book, you have to know what materiality is, because we're looking at the risk of material misstatement. If we don't know what materiality is, then the term risk of material misstatement, it doesn't make any sense. So this is the foundation of doing your risk assessment work. Use materiality and performance materiality in planning your audit, and we're applying the performance materiality at these transaction levels. Another concept that appears in this area of materiality is trivial misstatements. So what is a trivial misstatement? Well, as you would guess, it's something that's not important. You're going to compute and document your trivial misstatement amount, and it should be relatively low. So let's say that materiality is $1 million and your performance materiality is, say, 700,000. You might compute your trivial misstatement at, say, 5% of materiality. So in this case, it would be $50,000. And what you're going to do with that trivial misstatement amount, if you find an error, say in accounts payable, and it's $35,000 and your trivial amount is $50,000, you're going to pass on the adjustment on the work paper. In other words, you're not going to propose an audit adjustment because it's trivial. And you would do this on any area that you're auditing, whether it's cash or receivables or whatever it is. If the misstatement is less than your trivial amount, then you're going to pass on proposing an adjustment on the work paper, and you'll just say on the work paper, I note a misstatement of $35,000. I'm not making a correction because it's a trivial misstatement. So how does that help? Well, obviously it saves you time because you're not having to propose an audit adjustment and then have a discussion with your client about that adjustment. We see on this slide for trivial misstatements, there's no audit entry, and we pass on the adjustment at the work paper level, and then they're not accumulated as a past entry. Now you want to make sure on your materiality amount that it's low enough that it doesn't allow the cumulative trivial amounts to become material. So if you expected lots of trivial misstatements that were, say, $20,000, $30,000, $40,000, and you had, say, 15 of those, well, altogether those might actually be material. So you want to make sure your trivial amount is small enough that the cumulative past amounts, because they're trivial, would not become material. In the next video, we're going to be talking about gaining an understanding of the entity and its environment. Today, we were taking a look at materiality in Chapter 3. So next week, we're going to be looking at gaining an understanding of the entity and its environment. And of course, all of this is a part of risk assessment. And I'm doing a series of videos here about this book, Audit Risk Assessment Made Easy. So if you'll get a copy of the book, you can follow along in the book as we do the videos each week. Next week, gaining an understanding of the entity and its environment. So I will see you then. Till then, take care and bye now.